Welcome to Tesla Daily News Podcast. I'm glad you're here. Today is Sunday, January 20th, 2026. We're talking about a big shift in Tesla's driver assist packaging, what's really going on with Robotaxi operations in Austin, a key twist on China full self-driving expectations, and a couple of competitive and policy headlines that could move the stock. Story 1. Tesla just changed what standard means for driver assistance, and it's a direct play for higher software revenue. The hook is simple. Tesla removed Basic Autopilot, including lane centering, as a free included feature for new Model 3 and Model Y buyers in the US and Canada. The context here is Tesla's core auto business facing margin pressure, while the bull thesis continues to lean on software and autonomy monetization. The details. Multiple reports say new buyers now get traffic-aware cruise control as the baseline. But lane centering, often called autosteer, is no longer included and sits behind Tesla's full self-driving subscription, priced around $99 per month. The impact for investors cuts both ways. Positively, Tesla is trying to increase recurring, high-margin software revenue per vehicle, the kind of revenue stream that can expand valuation multiples if attach rates rise. Negatively, it objectively reduces the value proposition of the base car compared with many mainstream vehicles that include lane centering at no extra cost. And that could weigh on demand or push consumers toward competitors if price sensitivity is high. The takeaway: watch for whether Tesla discloses improving take rates for the subscription. If adoption rises without hurting deliveries, this is margin positive. If it triggers demand softness or bad press, it could be a short-term headwind. Story 2. Robotaxi in Austin is no safety driver, but it's not truly unaccompanied, and that nuance matters for valuation. Here's the hook. Tesla's Robotaxi service is being reported as operating without a human inside the vehicle, but with a safety or monitoring vehicle following behind. The context is that investors price Tesla partly as an autonomy platform, and credibility around operational autonomy influences analyst sentiment. The details. Coverage suggests Tesla shifted from an in-car safety monitor to a trailing chase car approach, still a human-in-the-loop mitigation, just moved out of the cabin. The impact. This can cool near-term hype because it signals the system still needs operational scaffolding to run at scale. And scale is the whole point. The economics of Robotaxi change dramatically if every autonomous car requires another staffed car to shadow it. On the other hand, staged rollouts with layered safety are normal in autonomy, and Tesla can argue it's iterating toward lower-cost supervision. The takeaway: investors should focus on two metrics: how quickly Tesla reduces supervision per mile, and whether the service area expands without incident. That's what ultimately drives the business case. Story 3. China is pushing back on timelines for approving Tesla full self-driving, and China is too big to handwave. The hook. Reports indicate Chinese state media is rejecting Elon Musk's suggestion that full self-driving would be approved in China as soon as next month. The context is straightforward. China is Tesla's second-largest market and a key part of the long-term autonomy revenue story. The details. The reporting frames it as China effectively shutting down the timeline, implying regulatory approval is not imminent. The impact. If investors were building near-term upside into the stock around an accelerated China FSD rollout, this can take that catalyst off the table. It also highlights an ongoing risk. Autonomy is not only a technical problem, it's a regulatory and data governance problem, and China's requirements around mapping, data localization, and safety oversight can slow deployment. The takeaway. Treat China autonomy revenue as longer dated unless Tesla provides concrete regulatory milestones. Near term, the auto business in China still matters more than speculative autonomy upside. Story 4. A new insurance angle is catching Wall Street's attention, and it's about liability in a self-driving world. The hook. Morgan Stanley highlighted what it called a critical unlock tied to insurance products designed for self-driving cars, starting with Tesla. The context. In autonomy, the big question is, who's liable? If risk and liability can be priced and packaged cleanly, it removes friction for broader adoption. The details. The reporting points to an insurer offering a policy tailored to self-driving use cases, beginning with Tesla. The impact. If credible insurance coverage becomes standard for autonomous operation, it can help adoption and reduce consumer anxiety, and that can feed the Tesla autonomy narrative. But there's also a valuation risk. If true hands-off autonomy arrives, liability may shift more toward manufacturers, which could increase costs unless Tesla controls that insurance margin itself. The takeaway. Watch whether Tesla expands its in-house insurance footprint or partners more deeply. Insurance can be either a margin tailwind or a hidden cost center depending on who owns the risk. Story 5. U.S. charging policy just got a jolt, and it's a quiet positive for the entire EV ecosystem, including Tesla. The hook. A federal judge ordered that approximately $5 billion in national electric vehicle infrastructure funds must be made available to states after being illegally frozen. The context: charging availability remains a major adoption constraint for non-Tesla buyers, and Tesla increasingly monetizes charging through its network and partnerships. The details: this funding supports public fast charging build-out. The impact: more public charging reduces friction to buy any EV, and historically, Tesla benefits when the EV market grows overall. It also potentially increases utilization of sites where Tesla is a supplier, partner, or network participant, depending on how state programs are implemented. The takeaway: this is not a tomorrow morning earnings lever, but it's a medium-term demand and infrastructure tailwind. Investors should track how much of this translates into deployments compatible with Tesla's connector strategy. Story 6. Competition is escalating on charging speed and pricing pressure, and that can shape Tesla's margins. The hook: BYD is talking up megawatt-class charging in Germany with claims of roughly 5-minute charging for up to about 400 kilometers of range starting in 2026. The context: Tesla's competitive advantage has long been a mix of cost, scale, efficiency, and its charging network. If rivals compress charging time dramatically, it changes consumer expectations. The details: the announcement is positioned as a technology and infrastructure push in Europe. The impact: if competitors deliver on ultra-fast charging at scale, Tesla may need to respond with its own charging upgrades or pricing and product adjustments, potentially affecting capex and margins. However, bold charging claims often take time to translate into real-world networks. The takeaway: investors should separate marketing from deployment. What matters is actual station rollout, reliability, and cost per delivered kilowatt-hour. Before we wrap, the market setup for Tesla is also about macro and earnings. Next week has heavy catalysts: the Federal Reserve meeting and major tech earnings, including Tesla. In this environment, anything that changes the narrative on margins, demand, or autonomy credibility can move the stock quickly. Quick recap for today. Tesla is pushing harder into subscription software by removing free lane centering. Robotaxi progress is real, but still supervised in practice. China FSD timelines look less near-term than hoped. Insurance and charging policy developments could support adoption, and competitors keep raising the bar on charging promises. That's it for Tesla Daily News Podcast. If you want these updates every day, subscribe and follow wherever you listen. And for tomorrow, keep an eye on earnings previews, delivery chatter, and any new details on FSD regulation, especially in China and the US.